US equities rebound as mega technology stocks lead gains ahead of Tesla and Google earnings that are due today after the bell. US crude slips below the $80 per barrel level. The US dollar remains soft. The euro and sterling, on the other hand, trim their recent gains on rising odds of upcoming rate cuts in Europe as well, while the Japanese yen consolidates its gains on the expectation that maybe, but just maybe, the Bank of Japan could hike its interest rates next week. So welcome. This is Swissquote's Daily Market Talk. So the week started on a bullish note in Europe and in the US as Joe Biden's decision to leave the presidential race didn't impact the market mood much on both sides of the Atlantic Ocean. The S&P 500 rebounded 1% after having recorded its worst week since April on a big technology sell-off and on rising worries that a second term for Donald Trump in the White House would worsen the global trade relations. Nasdaq 100 gained more than 1.5% as the Magnificent Seven stocks climbed 2.5%, led by a nearly 5% jump in Nvidia and a more than 5% jump in Tesla. So Tesla and Google are due to report their second quarter earnings as soon as today after the bell, and their results, or say the reaction to their quarterly results, could shift the wind in either direction. Note that despite almost doubling its stock price between April and July, while Tesla sees appetite for its cars and its market share under pressure, and the company's operating profit is expected to shrink in the second quarter of this year for the sixth straight quarter. So what keeps optimism alive for Tesla and its stock is probably the robo-taxi plan. But note that robo-taxis will cost to the company a lot before, they can generate any profit. Therefore, while the recent gains in Tesla's stock price may not find a solid ground to let the share price extend gains after the results, note that the key support to the robo-taxi-led rally stands at $220 per share level, which is the major 38.2% Fibonacci retracement level on April to July rebound. For Google, while investors will be closely watching the cloud revenue and whether the AI spending is making any difference for the advertisement revenue. Now, for this quarter, analysts are expecting impressive numbers, mind you. Google's earnings per share is expected to have risen from $1.44 to $1.85 and its revenue from 74.6 to 84.35 billion US dollars. So this would mark a significant increase from the same period last year and will give some hope that the AI trade is not yet exhausted and could also actually give a positive or a negative spin to Facebook's Meta as well from tomorrow, because both of these companies, both Meta and Google, rely on advertisement revenue that should ideally increase with AI tools. Now the thing is, and risk is, given the sky-high valuations in big technology stocks, any delay in AI revenues, any unpleasant details, or any misstep could actually have a sector-wide negative impact and lead to a rapid sell-off in AI-related stocks, and a sell-off may also be on the menu even if everything looks well. Because look at TSM, the share price took a hit since last week despite strong quarterly results that the company announced just last week. Now here in Europe, the Stoxx 600 index also gained more than 1% at yesterday's trading session, and while the earnings season here in Europe started on quite a relatively positive note with around 30% of the companies that reported beat the profit expectations. The lower European Central Bank rates are expected to have this positive impact on the company results and on the company profits, but analysts have been trimming their expectations regarding the earnings season since weeks now, and luxury and airline stocks here in Europe don't look in a great shape, unfortunately. Ryanair, for example, saw its shares plunge 15% yesterday after cutting its summer fare forecast because of materially lower prices of tickets, as people are simply sick of paying the price of a travel to Asia just to fly around Europe. At least that's the case for me. And that reluctance from consumers here in Europe to carry on the weight of higher prices may be bad news for company profits, but it's clearly good news for inflation expectations, and for central bankers, because it means that the companies are visibly losing their pricing power and should simply stop hiking their prices if they want to sell their goods and their services to people who actually continue to struggle with the ongoing cost of living crisis and high prices. So in the same context, while McDonald's is also looking to extend its $5 worth of a value menu in most US markets, as the company now thinks that that deal is boosting traffic in its stores. So all these are encouraging news for your central bankers and for your rate cut expectations. So in bonds, the US 2-year yield consolidates near the 4.50% level. The US 10-year yield is sitting close to the 4.20% mark, and the US dollar index remains over near its 200-day moving average. But the US dollar weakness is obviously countered by higher expectations of interest rate cuts from other major central banks here in Europe as well. So the Euro bulls are quite timid into the 110 psychological mark against US dollar, while cable is back below the 1.30 level on uncertainties regarding the Bank of England's next move on its interest rates. In Japan, while the Japanese yen gains some strength due to FX interventions, obviously, but also on some hawkish expectations building into next week's Bank of Japan meeting that actually could bring an interest rate hike, according to some in Japan. So we hear growing pressure from the political figures in Japan as well. In this context, a senior official from the ruling party, that I won't try to pronounce the name because it's just too hard, has urged the Bank of Japan to, clearly communicate its plan to normalize monetary policy through steady interest rate hikes in Japan, noting that the excessive decline of the Japanese yen is harming the Japanese economy. And Prime Minister Kishida also emphasized recently that normalizing the central bank's monetary policy and rates would actually support Japan's transition to a growth-driven economy. So, the Japanese yen may be coming to a crossroads near the 155 against the US dollar. Either a concrete policy action from the Bank of Japan will back a further rise in the Japanese yen and back a further decline in the dollar yen toward the 150 level, or we will see the pair struggle within this infernal cycle and maybe pressure back to the 160 level and above after the BOJ decision. Elsewhere, the Bank of Canada is expected to trim its rates by 25 basis points when the officials meet tomorrow in Canada. Now, in the energy space, US crude slipped below the $80 per barrel psychological and Fibonacci support yesterday and tipped a toe below the 200-day moving average level, and that despite the People's Bank of China's rate cut decision, the reflation positive market environment, and also despite supply concerns on rising geopolitical tensions in the Middle East and the Canadian wildfires. So, the expectation that OPEC will actually start unwinding its production restrictions in the final quarter of this year, and the rising odds that a Donald Trump presidency could further boost the US oil production take the upper hand in the market right now. So, from a technical perspective, US crude has now slipped into the medium-term bearish consolidation zone and could experience further declines in the coming weeks. Next support is seen at $78.60 to $78.80 region and should be quite strong given that the rising expectations of rate cuts from the major central banks around the world is still positive for oil prices in the medium run, while offers now look crowded into the $80 per barrel level. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.